July 17, 2025. Hard to believe. And I am Tim Quast, and along with me today is, as usual, Brian Wilson, who flew solo. Everybody showed up for Brian. Word gets out that I'm coming, and half the audience is like, well, I might as well skip this one. So, so anyway, that means, by the way, since Brian covered this last time, that I have to go first. So yes, I saw that. I saw after the fact, Candace, that there were a lot of questions. So what I should do is just let Brian do these, right? So I saw that it was very interactive, and that's what we want. We want this to be very interactive. We don't know everything, and we all make mistakes. But we do know a fair amount about these data and how to help you make the best of them. And again, and by the way, I continue to work on these model portfolios. It's a core. There are three big things that I dedicate time to basically every day, and it's one of them. And I'm very happy. We're running these data every day. Very happy with them. I found some interesting things out, and it's not a surprise that size matters. So that the larger you try to make your portfolio, the more it deteriorates your returns. On the flip side, if I could go give you a portfolio of 5 momentum stocks that are up 30% this year. That comes with risk. What happens when a whole bunch of people are buying those same stocks? Well, all those things come into play. It's part of that Jane Street story, which I continue to say is one of the great market structure stories of the modern era. And it's gotten a fair amount of attention, but perhaps not as much as it deserves. But one of the elements of that story is how they were using a very small number of equities, 6 of them. They were using 6 bank stocks in India for the other leg of their, I'll just call it the long-short strategy that they played. And they made a colossal amount of money with that. And of course, then the regulators scrutinized them and they said, we're just engaged in basic arbitrage. And in a sense, I think it's probably true that they are. But it also dispels the notion that these high frequency traders like Jane Street are somehow, an altruistic provider of liquidity or market maker. No, they're statistical arbitragers. That's what they are. And they're looking for patterns and ways to produce returns, as are we. That's what we're doing too, right? That's what we're doing. Okay, so with that preamble, let me get to it here. I'm going to share my screen and we'll come back to this. I'm going to pull up Brian Wilson and use some slides. So, thank you for that, Brian. But I'll come back. That's number 2. I want to come back to it. First of all, let's talk about volatility. We look at what are the broad trends, broad sentiment. What is the context? Today at noon, index options expired. Everything ran up into that, right? And we're right kind of at all of the volatility. If you're very close to it. So that is the reason behind it. It's not because of, look, you can say anything now about, well, we could send 150 countries letters telling them that we're going to impose significant tariffs. And in April, the market would have fallen apart. And now it goes up. The Dow's up 250 points. S&P is up 35. This is about index options. That's what it is. There are very large baskets, and in this low volatility environment, everybody wants to sell volatility. Can I buy something and write something against it? And that is absolutely what is occurring. Now, I don't know what happens tomorrow. Tomorrow's the other shoe, which is it's the very same thing Jane Street was doing. Jane Street was trading baskets of options on equities and index options. That's what they did. And all of the studies that the regulators did were centered around what? When those things expired, because volume and activity exploded. And so are we supposed to believe that that strategy is only occurring in India? I can guarantee you it is not. It's occurring in our market too. That's what they're doing. And so when we know these things, we know what we can do with it. There are opportunities to produce returns from volatility. So to finish the thought, you have context, then you look for divergences, and the you know the software and the mathematical models will do all that for you. You don't even have to take any time to do it. But I'm going to zoom in on a particular piece of this. That's volatility. By the way, the default sort is volatility. The most volatile item in the daily trading ideas momentum portfolio today is QS. I don't even know what that is. Maybe you do, but what's very interesting is to me how there are smaller things in this portfolio now. If I look at this, so the whole thesis here is you want to take part of that volatility. Something that is almost 10% volatile could move on you. But look, we know what the market's doing. Probably produces, I haven't checked, but you probably produce a very nice return trading that. Here's the Hicks rule would be right here it hits 10, and day over day, the supply dropped. What is the probability of producing a return? Very nearly 100%. Nothing is 100%. We just default to whatever the math says. Maybe we should round that to 99.9% so people don't draw the wrong conclusion. But that condition is very good. And even with this jump above the trend, if supply declines, there's a probability of producing a return. That's how the market works. And so then you have to think about what I call the 1, 2, 3 rule. Generally speaking, trackers of 90% of market cap, the S&P 500, and there are 3 of them. They all behave very similarly, but we'll take SPY, have a propensity to have volatility, the move between the intraday highest and lowest prices of about 1%. It's almost half that right now. Call it 7/10. I mean, it was back up a few days, and it was about 50 basis points, which is basically where the market is. And the small caps are up more than that, 1%. They're more volatile. Clearly, that's going to move differently. But have you noticed, and a quick sideline, how if the Dow is up one day, then it's down the next day. And then at some point, everything becomes pretty close to the same percentage change in price, and then maybe something moves again. That is arbitrage, and it's everywhere. It is pervasive in the market. And I'll show you some things here in just a moment that will explain the money behind everything that we're seeing. Coming back to these data, the core thing is to take the piece that the market gives. If we know how volatile something is, and we know that there's a demand supply divergence, and you can mute me, Brian, if you need to, and then just unmute me. I should have mentioned, please mute yourself if we're discussing something, just so we don't pick up background noise. And number 2, ask us questions. These conditions work very well to take a piece of whatever that volatility is, because the other 2, the 1, 2, 3, 2 is how much the underlying basket tends to move, about 2%. The S&P 500 components, about 2.2% volatile right now. That's right in line with long run averages. Momentum is 3% or more. That's why we screen for 3% or more volatility. So that's what you can do. Almost in any condition, things may behave differently than anticipated around options expirations. You always have to be aware of that. But there's the whole picture. If you look at the big, what's happening in the broad market, are there things, the cadence and the calendar of the market that you should know? Beware of those. Divergence, let's let the math of the market hand those easy opportunities to us, and then you just take your gains and you wash, rinse, and repeat. That's the absolutely the best way to use the data. We're working on the longer range portfolio view because it makes it possible to just let it do its thing, and that's even better. Okay, so questions, comments, observations before I go to my second part, and then I'll hand it off to Brian right after that. Okay. All right, so let me share this. And I'll explain what you're looking at. These are comparative. We have, we do a lot of period and pattern views. We look at how do things compare period over period, and what are the patterns that manifest over time. So I just wanted to look at the underlying data from options expirations to present. And if you look at what happened, so, picking up from December 31 last year, right into options expirations in January, and comparing it to what happened out the other side to February expirations. So call it, it's a comparative period of about a month. What happened in that period of time? Well, this is for SPY. And SPY was basically flat from December 31 to February 21. Underneath it, look at the very, very large role passive money played. There's some active money stock picking, smallest constituency now. Passive money was up 17%. And if you look at, volatility decline below the 1%, 1, 2, 3 rule, there it is, manifests over and over. Little increase in short volume, market basically flat. But there's always the engine of the market. Let's step forward to, because at February options expirations, everything changed. And conditions were kind of similar. I'll come to that in just a moment. So from February 24, picking up the next trading day and going to March expirations and comparing that period to what followed into April expirations, market was down 6%. Passive money was down 21%. Passive money didn't leave. I'd say active money was the seller in here. Volatility jumped by 50% or more, 2.9%. Short volume jumped 31%. It really bottomed right in here. Right at March expirations, it was 43%. Pretty amazing in SPY when it runs a lot hotter than that. Okay, so it's just interesting to see the importance of the presence or absence of passive money. It's the engine. Then we get to the April 21 to May 20, so into May expirations, and from May expirations to June expirations, what happened? Nothing happened. In effect, nothing happened. The net change, from point to point, there's stuff in between was 20 basis points, 0.2%. And if you look at the behavioral change, almost nothing. Volatility came right back into line with the expectation of about 1%, 1, 2, 3. Short volume continued to rise, 67% at, did I just move that? I did, didn't I? Sorry. There we go. There we go. No, it's still right. 67% at June expirations. And then last, let's see what's happened since. So between the June expirations period and yesterday, the market is up, SPY is up about 5%. And there it is again. Passive money is up 20%. Active money isn't doing it. I mean, you could go listen to all the talking heads and, investors are really enthused about, well, it's not true. Rational people aren't doing this. It is the relentless requirement of ETFs to deploy capital that is responsible. And look how low volatility is, all the way down to 70 basis points. And that's actually up because of the last 2 days. It was pretty close to 1%. As we began, we hit options expirations and that happens. So why is this occurring? Well, here's the last slide. And there are a lot of data on this. I'll walk you through very carefully what this is. So this is Investment Company Institute data. This is an internal presentation, so it's not all footnoted. I'm just sharing it here with you. But the Investment Company Institute tracks the entire ETF complex. And I'll show you some important things to know. Number one, this is the most recent data. We'll have June data around the last day of this month. July 30, they will put it out. There are 3,913 ETFs trading in the US market. Half of those are equity. The others are other things. But that is a massive number when you consider that the Russell 3000, the 3,000 largest stocks in the market, are basically 99.9% of market cap. And then look at this. From May 2024 to May 2025, how much money flowed into ETFs? A lot of this is conversions. So you got a mutual fund, and that has to be priced once a day, and everybody has a proportionate claim. Could we convert that thing to an ETF? Vanguard, State Street have done a lot of this. Vanguard has done a bunch of it. So their, assets were, call it, 9 trillion, May 2024. And as of May 2025, they're all the same as 11 trillion. $2 trillion to deploy. Well, that's what you get. That money relentlessly pumps out and it goes into the same stocks. If you look at the average component of the S&P 500, it's 10% below its all-time high. The whole market has not recovered. So how is it the benchmark has? Well, a very narrow band has done it. And I'm going to go back to the momentum portfolio to make this last point. But that's what's going on. Right? You don't need to know, you'd say, well, this would be really nice data to have. All factors into demand and supply. One element of it, it doesn't increase your capacity to know what's going to happen to a stock or a portfolio or to the broad market. But underneath it, we can put all of that data together and see what's occurring. And it's good to know, and you say, well, what causes that to stop? And we will come to that. I've got one more slide to show you. But back to the momentum portfolio, here's the interesting thing to me. There are just two in here that are part of the call it 130 that are 70% of market cap. I mentioned before that I talked to the people behind two very large ETF platforms. They're the ones who make it possible for this relentless flow of ETFs to continue to hit the market. They take care of all the regulatory requirements, the bookkeeping, everything. One of them's called Tidal. The other one escapes me at the moment. They told me 90% of ETF assets are in large caps. So you could have a great, vast variety of ETFs like quantum computing and AI and this thing and that thing. And they all own the same stuff because there's only so much stuff. And there's only so much stuff that you can get into and out of. And there's only so much stuff with the liquidity that people want. Well, here are two of the 100 largest stocks in the market. What is it? Arista Networks and Strategy. That used to be 2 years ago. This company was in the Russell 2000. Now it's one of the largest companies in the market, and everybody's concentrated into that stuff. And that's the stuff that outperforms. It's also why we tend to concentrate on large caps because you have a better chance of getting in and out. We want to reduce the risk and increase the probability of consistent small returns. It's the way to do it. Okay, to answer my question and then hand this off to Brian, what causes this to stop working? The absence of volatility. When volatility goes away, how do you arbitrage it? I mean, if you're looking for, arbitrage is buying and selling the same thing at different prices. Well, ETF stocks and options on both are really the same thing. They're all the same thing. And Jane Street, Citadel, Susquehanna et al., they want to just take a little piece wherever there are gaps. That's what they do. Well, what if they consume all the gaps? That's where the problem arises. And you never know. I don't know when it's going to happen. It's very interesting to me that what we haven't had in this period of time, this is the, wild April volatility. So let's go, and I've done this before, compare historically. You go back to 2018, there were two legs to that. They were both monetary. But there was a lot of volatility. There's a spike and a lot of volatility, and then volatility goes away, and wham, we get the other leg. And, you could say this was a leg, not very big. Here's the pandemic. We pumped the world between here and here, pumped $16 trillion into consumption. And that money will be, Gresham's law. It will flood into risk assets. And that's inflation. And then what always follows? Inflation. Well, deflation does. So you could say, here's leg one, a lot of volatility, mostly up. And then the volatility went away. And then we had leg number two. And then we've had a fairly normal market, and we have leg number one. Now, maybe we only have one leg in this, except that is not the way that the market works. Nor have we had even that smattering. It's like you have a little, some sprinkles and some thunder and some lightning, and then wham, you have the storm. We didn't have that. It is reverted. Now, I don't know what that means. Now, maybe we just have one leg. I will continue to say that because of the historical data set that we're going to get another one. And because this was the largest in the entire data set, I expect it's going to be meaningful. Now, Jamie Dimon could say the same thing about the economy. Like there's a hurricane sitting right up there and it never showed up. Well, it hasn't yet. Doesn't mean it hasn't. And I don't sit around worrying about these things. And I think that economically, we are doing some very good things in the United States that are excellent long-term undertakings. I just think that there's going to be something else that happens. You can't predict when. And we can talk about what's next after that. But it's why I say I haven't seen the rest of it. And I said on CNBC, I expected it maybe late in the third quarter, maybe the fourth quarter, just looking at the amount of time that it takes. We have no $16 trillion extending the arc way out this time. It could be very rapid. I don't know. I look at these probabilities and I do think about the potential risks. Okay. That's what I've got. Brian, over to you.
Thank you, Tim. Much appreciated. And by the way, Pat, nice to see you. I sometimes do some backup work for Pat, but I don't think we've ever met. So great to actually meet you, Pat. I wanted to start. Brad had a question about MicroStrategy in terms of, is it a good time to continue to he's got some profits in it, which is fantastic. Let's go take a look at that and, kind of assess, what should you look at, for MicroStrategy right now. So it's been 9 or 10 for, a couple of weeks now. Short volumes are really low. It's in a great position in terms of letting it run. The only issue here to me, and Tim might have another thought, is we just don't know what happens as the focus shifts to the August series next week. This is a fantastic run into options expirations. If this is me trading it, Brad, I take a quarter of my profits or a half of my profits at these levels. It's just me, though. It's just the way that I approach it. The data is great. It's a perfect setup for further appreciation. We just don't know what that looks like as we move into next week or even tomorrow. We could potentially have some profit taking tomorrow as well. So that would be my thought on that. Tim, did you have any thoughts as it pertains to that?
No, the data look great. Diverging demand and supply are awesome, but we always say context and broad sentiment will always have some effect on the probability of return. So you just have to be aware of that. It could erode the probability that you have a continuing return. I mean, demand and supply in the broad market are converging. We haven't seen the effect yet, but that's the point. It's predictive. Doesn't always happen. But I agree with that. As good as that looks, I mean, if we had in the broad market, demand and supply were diverging, and we were not in the middle of options expirations, I would be plowing money into that. But as it is, I agree, Brian.
Yeah, no, perfect. Hopefully that helped, Brad. I wanted to spend just a couple minutes on the daily trading ideas. Most of you guys are familiar with what I do on a daily basis, but this is kind of my morning routine. I'll just go into the momentum portfolio. I'll sort it by the top names. And then what I end up doing is just dropping it into a watch list. So, there's my watch list for the momentum portfolio today. Generally speaking, I'm not going to do too much during the course of the day. The last couple of days, I veered away from that just a little bit. Part of the reason for that, I actually picked up ANET yesterday on an intraday basis. Why did I do that? Well, I looked at the setup for ANET. I liked it. And I think it was about 2 hours before the close, something like that. It was starting to, let me see if I have an example here. Pretend this is ANET yesterday, and it was starting to move higher during the day. It was starting to move higher, and I'm like, you know what? If I, want to hold it overnight. I'm comfortable doing that. I bought a smaller position, and then it started to run higher. And I'm like, great. I took 1%, 120 basis points, something like that. If I can close it out at the end of the day with a profit, fantastic. I wasn't sitting around watching it, but it looked like it was going to move higher. And once again, I just bought a small position, and I was going to add to it at the end of the day, if need be. Uh, I actually did the same thing today. I bought Veronis right around in here. I was looking at the name earlier. It looked fairly promising. It wasn't up as much as the other names that were in the momentum portfolio. And once again, it was under the premise that, hey, if this doesn't work on an intraday basis, I'm just going to add a little bit to it at the end of the day. So most of the time, I'll trade the last 10 minutes of the day. I've traded a little bit here the last couple of days just on an intraday basis. I did it with Warner Brothers this morning. I bought it somewhere in here. You can see, nice profits. I didn't, it could have slipped down, but I like the setup. And if it did slip down, I was willing to add to the position at day's end. But that's the approach that I'll take is I'll drop everything in a watch list. And for the most part, I'm just looking at the end of the day for potential entry points. And once again, for those that are new, what do your entry points look like between the entry low and the entry high? It's just that simple. I haven't looked at this one today, but as an example, OS, or is that QS? It's not getting as much upside as some of the other names. I'll take a peek at that at the end of the day, and potentially move into that one. I do the same thing with low volatility. And to Tim's point, sometimes you'll see on a given day where all the movements in low volatility, everything's green and low volatility. And then the next day, everything's green and momentum. And sometimes you can get that back and forth approach to the data. I wanted to talk for just a moment. Had a great question from one of you guys a little earlier in the day. And the question had to do with, hey, the broad market's just in rally mode. Is the data working? We're getting to these market tops, and the markets just don't seem to slow down. I would argue that actually, yes, the markets have been slowing down at market tops, and then we continue as the focus, shifts to the next series. But look at what was happening here at some of these market tops. This was back in January. Markets slowed down above the red line. So think of the red line as overbought or stretched conditions. Fast forward to March and April. Market slows down at the red line. In fact, this was Liberation Day. Of course, there was other dynamics coming into play. Look at what happened here in May. Market slows down at the red line. Once again, here in June, market slows down at the red line. And it's done the exact same thing here. We came through the red line, and we've basically gone nowhere for about 2 weeks. You might ask the question, well, why does the market continue to move higher? Well, once we exit expirations, you can see it here in June, we come out of expirations. What happens? Basically, the same strategies get adopted again, and the market continues to move higher. I think part of what is playing out in the market is just incredible demand for big tech. And it's already starting to turn a little bit before the conclusion of this expiration cycle. So as you're aware, big tech constitutes about 40% of the weighting in the S&P 500. So it's a huge, huge component. Tim already covered part of it, that you're just going to have money that's plowing into the largest constituencies. If big tech is doing well, generally that's going to lift the S&P 500 as a whole. Now, there's going to be individual names inside of the S&P that are not going to perform as well, but the market as a whole is generally going to perform better. Here we have big tech just starting to move higher once again. at options expirations. Does that mean we continue to move higher next week? Well, that's certainly a possibility. I took a look here, and I'll take you back in time. Let's see. I was looking at the beginning of the year. So this stretch right through here, I didn't have all the dates. I had 95% of the dates. So I was looking at, what did big tech do during this stretch? What was the sentiment like for big tech? And we were moving higher, but it was certainly not at lightning speed. It was 5.15. Okay, well that makes sense, right? We're slowly moving higher. Sentiment for big tech slightly above neutral. This section, the weakness that we saw in the market from here down through here, once again, I had about 95% of the data, 3.6. So that was very telling. When demand for big tech fell, well, the whole market suffered. Sentiment for the rally that we've seen from late April going forward, and I think I have 100% of this data, 6.8 is the average sentiment for big tech. That explains why the market's been on fire. To me, it's a big reason why is because big tech has been on fire. You've seen me share this slide deck, and I just continue to update it. What the slide deck is just a comparison between 2020 and 2025. So this was just a huge run higher when we started to recover from the pandemic. As we did so, there was such incredible demand for stocks that there was incredible borrowing of shares to fuel that demand. Think of meme stocks, but think of the whole market as a meme stock. That was essentially what was happening here. It took about 3 months for shorts to actually start to get covered. By the way, in the meantime, I think this was a 67% rally. I'm going off of memory from lows to highs. In the middle of that was a 7% decline. That was a 10% decline. That was a 7% decline. We had some hiccups along the way. So even when the market is doing well, just beware, watch out for those levels that can sometimes come out of nowhere. 2025, this is what we're seeing. Very similar effect. Money was plowing into big tech. Once again, average sentiment was 3.6 for a period of about 2 months. Notice what happened to short volumes, the same exact thing as 2020. This was about a 2-month period, finally starting to get covered a little bit. Well, still high, but covered relative to how high they had been. Let me cover one other item before we kind of talk about what's ahead. This is just the predictive quality of some of the data. I love it sometimes going into big events. So what I've done here, I call this my big companies. What I've done is I've taken all the financials and then I've just stripped out the 13 largest by market cap. And it just gives me, and you can see it, I do it for all the sectors. Some of them are more meaningful than others. But for like financials and tech and other ones, sometimes the big companies will move before the other guys, either up or down. What I was looking at here was the setup going into the big banks and brokers reporting this week. What was the setup going into it? Well, sentiment was positive, but it had been slipping and short volume had been moving higher. Now, most of these guys reported very good numbers, but if you look at the day one response for a lot of them, it wasn't great. That day one response for a couple of the ones that I remember looking at, they were down 5-6%. Why was that occurring? Well, demand was slipping ahead of them reporting, and short volume was moving higher. Exactly the opposite of what you would want to see to support gains. So with that, I'll stop for a second, see if there's Any questions? Otherwise, I'm ready to kind of look at the path ahead, Tim.
Okay, good. One comment about the covering that we have seen, and it's this. I won't say it's terribly unusual. It's anomalous. It is anomalous, as Brian pointed out. There were those periodic pullbacks in the market because if you're short the market, now keep in mind that these market makers, they're basically zero exposure all the time. So if you are heavily short, they're clearly long something else so that their exposure is mitigated. But it is very rare to have covering without a dip. I mean, go look at data for anything over any period of time, and you will see that very consistently. You will see when a portfolio, a stock, the broad market, pick your measure, when they decline, if there has been short volume, there is a corresponding covering almost all the time. And in the broad market, if you look at this data from April to present, the market has not had a 7% pullback, and yet there has been covering. So does that mean people lost money on that? I continue to say we have not seen the consequences from both April and what has occurred here. It will always come around at some point. We didn't know for a very, very long time. It was months that Archegos Capital blew up and took down Credit Suisse, right? Credit Suisse no longer exists because of that. They had to sell themselves to UBS. They lost $8 billion in that failure. There are things out there that we have not seen manifest yet, I continue to believe. And when it does, that might be the next shoe. I don't know. And again, I don't sit around thinking about those things, but we certainly look at those data, right? We look at it and go, well, that differs from the historical pattern. And anything like that that does gets our attention. Maybe it's nothing. But the prudent always foresee evil and hide themselves. One of my favorite sayings, right? That you want to be aware of what's occurring. Doesn't mean that the risks will manifest, but you certainly want to be aware that they are there. And Anesh, that is a great question, by the way. I don't think anyone has ever asked that question. That's good. So Anesh asks, and I'll share it for the benefit of the replay, that when you look at the broad sentiment and supply charts in a dynamic portfolio, what does it reflect? Does it reflect the current components or does it reflect history? It reflects the current components because remember, if we're looking for tens, the whole thing would be at 10 all the time if it was just the historical data. So we are taking what is currently in it. But can we can go back and look historically at what has occurred. Good question. Let's see. Oh, we'll wrap up with this, right? Sorry, as usual, we take you a little bit long. Pat, we really should say these are 45 minutes, but if we did that, then we'd go an hour. So we don't do that, right? So wrapping up, what's next? Where I would go, Brian, is I look at demand and supply converging, and the market has not corresponded to that yet. Is it going to, or does it ignore it? That's so the only question. And if we run up with index options expirations, I don't know that tomorrow's the basket, right? So you have the indexes to AM dated. It's our only European style derivative in the U.S. market. AM dated index options. Tomorrow are stock options expirations. Monday there's a reset. I look at the data and it's not bad at all. I don't look at it and go, wow, there looks like a tornado in the data at all. Doesn't mean I've certainly positioned myself for some volatility. And I did it when volatility was 50 basis points, and now it's 100. So it's proved to be that was a good play. I'm making money on my volatility trade. It doesn't have to move much for me to benefit from a volatility trade. I always have when there are anomalies in the data, and I've shared this over and over. If there is an anomaly and there's a probability that anomaly has to be resolved, I may make some play on that. I'm not always right, right? I'm not always right about those. And you have to be prepared that if you're wrong about the probability of something occurring and it doesn't occur, then you just have to throw in the towel on that. It doesn't always work. But I have I have a volatility trade and I have added to, and you look at it and say, well, why would you do that? I've added to my short position. I thought yesterday when the market did what it did into the close, I thought, oh, well, it's going to go up tomorrow because if the market closes the full range of volatility, that tells me that you want to short, right? That because probably there's some mean reversion, and that's only true when demand and supply in the broad market are converging and when it's occurring during options expirations. We don't know if it's, is the effect going to manifest into options expirations, during them, or out the other side, or not at all. It will be one of the four, right? So that's always the case. And they're just probability plays. And, they can work beautifully or they can not. And can I tell you? No, but I will not be surprised by a spike to 3% volatility between now and call it Wednesday or Thursday of next week. And that's my play. I'm willing to, that is my time frame. If we're mean reverting, I'm out of that trade, right? You can't hang around with a trade that isn't going as the probabilities may present. So that's my thinking. Brian, how about you?
Yeah, pretty similar to what you were discussing. I'll just share my screen for one moment. Go back to big tech. It kind of begins once again for me with what big tech is doing. If we continue to be stable in terms of demand on the big tech side, we're probably going to be okay coming out the other side. I am watching the overall demand and supply. You can see, recently we've just never slipped that much. We've never come close to the green line. That's basically an entry point for the broad market. We didn't do it in June. We didn't do it in the latter part of June. What happens this time? Too early to tell. But if big tech is telling me anything, it right now it's saying probably the same thing happens again. It's really too early to know for sure. But big tech, broad sentiment. And then, of course, as you're trading from the daily trading ideas, just be careful with earnings. We're coming into that season. You could have the best, you get into a trade with SoFi. It's fantastic. And then you forget about earnings, and SoFi's down 10% with earnings, and you've taken a great trade and tossed it in the waste paper basket. So just be careful with those dynamics.
Good reminder, Ryan. That is absolutely right. You can get clocked by earnings, and everybody. We're pelting into the heart of Q2 earnings here. Steve, yes, please.
So when you're playing volatility, are you buying into VIX and UVXY?
Yeah. UVIX, UVXY.
Right.
Yep. Either one. I have to use UVIX because UVXY is organized as a a partnership, and Interactive Brokers won't let you trade that. I traded it a whole lot, and I had quite a debate with them, and they basically told me to go pound sand. I said, I've traded it a lot, and they said, we're sorry, that is no longer available for trading, even though it was. Yes. so I had to switch to UVIX, but it's the same thing.
Okay.
Yeah.
And Steve, we're trying to make note of that in the daily notes as much as possible. When we do have volatility that's really disappearing in the market, just so you can be aware of it. And it doesn't always happen, but usually those volatility events will then occur around some type of market structure event, whether it's expirations, whether it's month end, or what have you. Can there be a surprise like Liberation Day? Absolutely. But generally speaking, it's going to happen around some market structure event.
Okay.
Yep. I've got one last thing, and I'm sorry we kept you so long. I'm just going to point this out because I completely agree with Brian. We'll say the market cannot sustainably rise, the broad measures that is, without big tech. And it's also very difficult for the market to experience any kind of retreat if big tech is bucking that. There's no doubt about that. I would point out that large caps, this is an awful lot of the market cap here, but again, it's above, anything above 5, it's at 5.6, is still net positive. Now, supply is very high. It's very close to what we're seeing in the S&P 500. Keep in mind, the S&P 500, 90% of market cap. So I look at that, and then I like to look at mega caps too, as you all know. So, 2 days ago, there were 131 in here. And that number has gone steadily up. I think in January, this was 116. So the big keep getting bigger, which is why people look for a broadening out. There's no such thing, right? That's not how the market works. That is an ill-informed perspective that thinks that there are thinking people that are going to go over here and go, oh, that stuff is discounted relative to everything else. That is not how ETFs are created and redeemed. And one data point I left out here is this: the immense size of the creation redemption market. Year to date, there have been nearly 4 trillion of creates redeems. You net them, and this is what happens each month. April, 56 billion net, 78 billion in May. But if you look at what happened January, February, March, it was over 100 billion net. Additional ETF shares into the market. That is monetary. It is inflationary. It causes stuff to go up. And it's just enormous. It did come down in May. Well, that money doesn't look around and go, oh, that stuff is discounted. It says, I need stuff with these volatility characteristics, this liquidity, and that track the benchmarks, whatever they are. And then they become the benchmarks. And that's this stuff. So I'd look at this and say, it doesn't look bad either, but it doesn't look the same as big tech, right? Big tech actually has divergence. It hit 5 and has ticked up a little bit. And supply did the Hicks rule and ticked down day over day. In this group of 11, there are 11 in our default. But in the 129, that's not occurring. There might be a little bit of a tug of war. There's so much money now that needs exposure to ETFs that it can't just be big tech. It's got to be mega caps. So we'll see how it goes. And that's all I've got.